Hello and welcome back to the second section of our fourth quarter 2021 review. We're going to be looking at charts and data. So or data points, I should say, for the quarter and for the year. So let's get started, shall we? So I kept 5 headlines for you. The first one is obviously Omicron is still very much present, causing lockdowns in many countries, and obviously economies or the economic impact of these lockdowns is being felt. The other interesting thing is natural gas prices are soaring in Europe, so that's a problem for any manufacturing business and obviously for consumers and consumer spending. We're not going to talk about it in this section, but one can think about the causes as to why natural gas prices are spiking in Europe. Chip shortages and the associated, if you will, supply chain issues are still gripping the economy. Governments and central banks are still very much involved in our economy, in our economic life. But interestingly enough, the Bank of England was the first of what is expected to be many banks in the Western world to start raising rates from their emergency low levels, if you will. So those 5 headlines, to me, represent a lot of what happened in 2020. Soaring costs, chip shortages, and supply chain issues, and energy costs, as well as COVID-19 were sort of the 5 big topics of the past quarter. So let's talk about 3 ideas for 2022. Unintended consequences. So we're going to talk about that. Those are to me, it's an often overlooked concept, and certainly during this pandemic, it has been brought to the front of the line. The next is a reversion to the mean. The next concept is a reversion to the mean. It's one of those rules in investing that really you can ignore for a while, but they always eventually, the reversion to the mean always comes home. It always happens. And finally, there's a saying in investment houses and trading floors that an incentive will always trump ethics. But I'm going to change it a little bit and say, call it greed and fear trumps common sense. And then we're going to have some fun with that. And that will be the last chart. So let's get started. Let's talk about discretionary income and travel for a minute. So what we've got here is the TSA, so the fine folks that make us take off our shoes and our belts at those stations when you enter airports. So the real issue here is what? Well, we're still down about 15% from pre-COVID levels in terms of the weekly visits, about 2 million in terms of the checkpoints, and we were at 2.5 to close to 3 million depending on the time of the year pre-COVID. So what does that mean? Well, number one, people are still traveling in the U.S. and this sort of, it's fairly volatile, but you can see sort of the first spike, and then we've got the Delta, and obviously we're probably going to see a lower level in the coming weeks. We can see that there was initial rebound, flatlining for a while, and then as vaccines became available, the Americans started to travel much more. What we do know is that business travel, and I'll show you the next chart, business travel is certainly not happening in any stretch of the imagination. It's if you look at the announcements for many well-known conferences, they are happening, if at all, and they're going to be in a hybrid mode, or they're going to be in a virtual mode, or they're canceled altogether. So business travel is down substantially. Unfortunately for airlines, that's a large part of their profit. Same goes for hotels. Conventions and conferences are a big moneymaker for them. But Americans, by and large, are still traveling. We're still down 15% in the U.S., but we want to think about, well, if companies aren't spending as much as travel and the average American is not spending as much as travel, where's the money going? So let's look at business travel a little bit. So we've got the worldwide traveling volume of business. So you can see going back to 2000, the source is Oxford Economics, and we were those are the events. So this is coming down from a recession in the early 2000s. And we had the events of 2001. And so you basically had a flatlining of business travel or business tourism. And so it took about 4 or 5 years for the business to come back. We have a bit of a recession dip here, but basically we peaked at over basically $1.3 trillion. And then we were basically cut by more than 50% in when it comes to business travel expenses back in 2020. If we look at the leisure business, similar chart, the dollars are still substantially larger. They're 4 or 5 times larger, but the drop wasn't as dramatic in the leisure tourism as it was in the business tourism. So let's look at inflation and the unintended consequences of inflation. So what we've got here is the CPI numbers provided to us by Bloomberg. It's just a screen rip from our Bloomberg terminal. And what we're looking at is going back to 2017. We've got sort of obviously inflation goes up at 2 or 3%. We all know that. But then we have the bit of a little dip that we've got. That's the COVID dip in terms of inflation. That's entirely normal in terms of a recession. We sort of have a dip here when an economic slowdown and kind of a spike. So basically, there is some volatility to the number, but really when we get to 2021, the inflation numbers just spike dramatically. You have a 4.95 or call it a 5% spike in prices in CPI. And that is, you've got to go back 30 years to that type of change in terms of the trajectory of increases in prices. For anyone that's filled up their car, tried to buy a 2x4 at Home Depot or Lowe's to just buying groceries, you know that prices are up substantially. So what do we have? So we have, when you stop and follow the bouncing ball, you've got governments spending a lot of money. We're going to talk about that in a minute. And you have central banks being involved. And all of a sudden, there's a lot more money in the system. It is chasing a fixed number of goods. And so prices go up for those goods and those services. It's just the natural evolution of things. So let's look at government spending for a minute. So one of the narratives that right now you're seeing in the media that I wanted to dispel is the fact that central banks own a lot of sovereign bonds. In this case, we're going to look at the share of bonds outstanding or issued by the federal government. So we see that the number peaked at north of 40% in the late 70s. This was a period where inflation was really quite high, and central banks and governments' spending and deficits were also quite high. We can see that as central banks and governments start reducing their deficits, central governments start reducing their deficits, you can see that central banks also reduce their participation or ownership in federal bonds. And here we have this massive spike in terms of the Bank of Canada going from basically 12 or 15% ownership of bonds to nearly 40%. That is a drastic 1-year change. That move up is unprecedented. So why would central banks get involved in the bond business? Well, when you have a government like ours at the moment, and we can have a discussion as to whether they had to or not. It's not the point of this chart. But the concept here is that you've got a massive increase in deficits. Well, just like a household, governments have to finance this deficit spending, and they have to go out and borrow. Governments do not borrow from the bank. They borrow from the bond investors, which are effectively lenders. But when there's not enough lenders to buy these bonds, these government bonds, to finance the deficit, central banks have to start getting involved. And that's really what we have seen in 2020 dramatically. And it's a replay, of the previous decades. But you have to go back to basically nearly 50 years ago to have 40 years ago to get the same level of central bank involvement. Let's look at housing for a minute. Another unintended consequence of low interest rates. Many believe that high housing cost is a direct result of low interest rates. And in my opinion, they're partially right, but there's more at play here. There's unintended consequences. We're going to talk about, you're going to see more and more over time, this concept of donut cities, of basically city centers being there's an exodus away from city centers, especially large city centers, either towards the suburbs or towards other secondary cities. So what do I mean by that? So let's look at housing prices. So the index I have here for you from Bloomberg is the Terranet National Bank Index. It follows 11 cities in terms of the pricing index. The numbers, the index came out with 100, I forget, at a level of 100, I forget which year it came out with. But basically what you want to do is you want to follow the rate of change of this price. So you've got, increase of 3%, increase of 4%, and so on and so forth. So the numbers are kind of stable. And then they accelerate for 2016 and 2017. So why is that? Well, we have a pretty strong economy here in Canada. And then all of a sudden, things start to flatline, and then we have a recession in 2020, but the prices kept going up, which was kind of weird. So why is that? Well, number one, we have had an interesting sort of change in what cities are seeing their increase in prices. So Ottawa Gatineau, I didn't forget the U. There's just an Excel mishap here where there's not enough room when I transcribed it. My apologies there. But basically, a place like Ottawa or Winnipeg were kind of sleepily, I want to say, secondary cities where price levels were fairly flat, small increases, but nothing to write home about until 2020. So I'm showing you Ottawa Gatineau. It is the same thing here in Winnipeg, where you have kind of a slowly growing market, nothing to write home about, and these things start J-curving in 2020 and 2021. Vancouver, we know, was a very hot market. That continued. And the same with Montreal, which was basically a decent market starting in 2017. So that's basically what we're looking at are the 11 cities and then the larger 20 or 6 cities. And I wanted to show you those for example purposes. The other interesting part of this chart is you want to look at the existing sales growth, year on year. So you can see that in terms of number of homes being sold, the number is quite volatile. You have some flat numbers, some significantly down numbers, and some significantly up numbers. So obviously 2020 saw, in terms of number of homes sold, going up substantially. The next number I wanted to show you are housing permits. So why do housing permits matter? Well, for a simple reason that they increase supply as new homes get built. The concept is very simple. If you have high housing permits, a few years after those permits are issued, you should see more supply in the market, and prices should maybe abate, or the growth of the prices should abate, or maybe even flatline, even fall. Who knows? So I want to show you the evolution of this. So you've got housing permits being negative in 2012 and 2013. Okay, fair enough. And then slightly up in 2014. And we're seeing here in terms of a negative. So this is a negative or a tough housing market. But if you fast forward a few years later, in terms of housing starts, the number spikes a few years later. Why? Well, it only makes sense that at some point you want to increase the supply as it gets absorbed in the market. So we see a housing permit bump move in 2015, and then we see a significant move up through 2016 and 2017 in terms of housing starts. We can see sort of a flatlining in terms of new permits in 2017 and 2018. And guess what? The number of housing starts actually goes down between 2018 and 2019. So my point here is prices are up substantially. They're across the board, across Canada. Many people say it's because of low interest rates, and they are partially right. But what I would also argue is that housing starts have also a significant impact in housing prices. So let's talk about interest rates. They have come down. So this is the average outstanding mortgage rate throughout our great country. So we see in 2021, the average mortgage rate was 3.69. Let's call it 3.7%. And in 2018 and 2019, those rates were 4.25% to almost 4.5%. So that drop in mortgage rates basically means that the average mortgage cost for the average homeowner has gone down dramatically, meaning that there's more consumer spending available theoretically. That's where energy costs, which would also come in and either add or subtract to this additional capital for consumer spending. So the concept of this chart, we are seeing substantially increases in housing all over Canada, and we're seeing permits kind of flatline both in 2020 and 2021. And so there's just a lack of supply of late in terms of new housing starts, at least expected in 22 and 23 if you haven't had any new permits. Let's talk about reversion to the mean for a moment. We know that in the past year, interest rates have risen. How much? Well, let's look in Canada. Again, data provided to us by Bloomberg. This is the yield curve. So you've got term to maturity at the bottom and interest rates going on your y-axis or your vertical axis, I should say. So you've got interest rates a year ago, the blue line, rising tremendously. The pink line is the line. We talked about housing and the and the rising housing prices in the previous slide. Let's talk about reversion to the mean. As a homeowner, what we're really worried about is housing is nice if you own a home and the rise of it, but what we don't want is a housing crash. And so let's talk about reversion to the mean in terms of, will interest rates come back to such a level that they were going to affect housing prices and we're going to see housing prices sort of crater? Everyone remembers 07, 08, and 09 in terms of in the US and in Canada, but Canada was much more muted in terms of its impact around housing prices. So let's look at interest rates. So we've got here our good old yield curve. So the blue line is the yield curve, which is basically an illustration of interest rates over time for the maturities. So you've got a 20-year bond here. A year ago, investors were accepting a little over 1%, and now they're demanding over 60 basis points or 1.6% to invest in Canadian bonds for 20 years. And as you get closer in terms of maturity, meaning the bonds are for a shorter time period, you expect to make less money. So a 5-year bond a year ago would have paid investors 40 basis points or 0.4%. Now investors are demanding over 1.2%. So you can see that there's interest rates have risen dramatically. And why am I focusing on the 5-year number? Is that's where the mortgage rates are based on. They're based on what banks can get funding at, which is based on the interest rates prevailing for Canadian government bonds. In the US, the curve is very much the same. You have a significant rise in interest rates all along the curve, so all over the maturities, but you're really worried about the 5-year number, and that's called the belly of the curve. So 2 years to say 7 years or even 10. That's where the bulk of the interest rate movement happened in both in the US and in Canada. So the question is, rates are coming back. Are we coming back to the mean? And where does that mean? What does that look like? So let's look at the long-term history of Canadian mortgages. So I apologize, this is a rather old chart from the Bank of Canada. And basically what we're looking at is we went back to 1935 and looked at 5-year or the prime rate of mortgages. So we see basically the mean being around 5%. And then when this inflation hit in the 70s, rates rose and then they faded back down again to sub 10%. And really the early 80s, for about a 5-year period, interest rates rose dramatically, quickly, and then settled back down on this path down towards sub 10 again. And then, as we all know, Canada had a recession in the late 80s. Interest rates rose, and then we've been on a one-way path down in terms of interest rates. So really the question is, we know interest rates are rising. Are they going back to these types of levels? think we can agree that at the moment, it's certainly unlikely. There's no information. Is it possible? Absolutely. But the more likely scenario is we're going to come back to these types of levels, around 5 or 6%. It's certainly our base case in terms of long-term mortgage rates. Where would they settle back in terms of levels? Let's talk about the final one, then let's have some fun with it. Greed and fear versus common sense. So what we've got here is the market capitalization. So the value that investors are putting on Tesla as of October 25th, 2021. And it was slightly over $1 trillion. For the same $1 trillion, you can buy 10 automakers from Toyota, Volkswagen, Daimler, BMW. Stellantis is the Chrysler and Fiat merger. You've got Honda, Ford, BMW, SAIC, and BYD are Chinese manufacturers. So let me ask you this question. If you had $1 trillion, would you buy Tesla or these 10 car makers? To me, anyway, in my opinion, this represents greed and this more or less represents common sense. Here's another way to look at it. The global deliveries of cars, the estimates in 2021, these 10 car makers are expected to deliver nearly 80 million cars in 2021. Tesla, less than 1 million, maybe slightly above 1 million. We can argue about that detail, but clearly the gap is stupendous. So let me ask you this. Does this look like common sense when you look at the car deliveries and the market capitalization? Now remember, the car business itself, in terms of the number of units sold worldwide, doesn't grow very much. So if Tesla is going to grow into, and I'm using air quotes, into this valuation, this growth is, in terms of deliveries, is going to come at the expense of these 10 car makers. Thank you very much for watching. As always, if you have questions or comments, please send us an email, and we'd love to hear your feedback. I'm Benoit Poliquin for Exponent Investment Management. Thank you for watching.